After studying this module, we shall be able to know the various credit control instruments, learn about liquidity adjustment facility, know the repo rate and reserve rate, study the market stabilization scheme. Money market is a market for short-term instruments varying for a period less than or equal to 1 year. RBI regulates money and credit through its monetary policy. The monetary policy uses various techniques of monetary control at the disposal of central bank for achieving price control, stability, controlling and regulating liquidity in the market. A money market is a market for borrowing and lending of short-term funds. It deals in funds and financial instruments having a maturity period of 1 day to 1 year. It is a mechanism through which short-term funds are loaned or borrowed and through which a large part of financial transaction of a particular country or of the world are cleared. It is different from the stock market. It is not a single market but a collection of markets for several instruments like call money market, commercial bills market, treasury bills, repo rates, certificate of deposits, etc. The Reserve Bank of India is the most important constituent of Indian money market. Thus, RBI describes money market as the center for dealing mainly of a short-term character in monetary assets. It meets the short-term requirement of borrowers and provides liquidity or cash to lenders. In money market transaction of large amount and high volume take place. It is denominated by small number of large players. In money market, the players are government, Reserve Bank of India, Discount and Finance House of India, commonly known as DFHI, mutual funds, corporate investors, provident funds, public sector undertakings, PSUs, non-banking financial companies, commonly known as NBFCs, etc. Functions of money market. Number 1. It caters to the short-term financial needs of the economy. Number 2, it helps the RBI in effective implementation of the monetary policy. Here one point which needs mention. Once the fiscal budget or the finance bill is passed in the parliament by both the houses, which becomes budget, the government of India has to take care of its spending and collection. That portion of spending and collection requires issue of certain securities, which is done by RBI on behalf of Ministry of Finance in the form of monetary policy. Point number 3, it provides mechanism to achieve equilibrium between demand and supply of short-term funds. 4th, it helps in allocation of short-term funds through interbank transaction and money market instruments. 5th, it also provides funds in non-inflationary way to the government to meet its deficit. Point number 6, it facilitates economic development. Last point, it also ensures an adequate liquidity in the system. RBI, through its various instruments of money market like repo rate, reverse repo rate, yield to maturity on a treasury bill, try to control the interest rates in the economy, and interest rate bottom the line helps in controlling the inflation in the economy. Credit control instruments. The Reserve Bank uses various quantitative and qualitative tools for managing liquidity in the market. Quantitative credit control instruments, bank rate. It is the rate of interest charged by RBI from the banks on the loans and advances given to them. As per section 49 of RBI Act 1934, Bank rate is the standard rate at which the bank is prepared to buy or rediscount bills of exchange or other eligible papers. This technique is used to regulate the cost and the availability of refinance. On April 4, 1935, RBI fixed 3.5% bank rate. Till the year 1951, the RBI did not use bank rate as an instrument of monetary policy. In all these years, RBI adopted cheap money policy. During the first plan, BR raised to 3.5%, then raised to 4% in the second plan. During the third plan, bank rate raised to 6%, then to 7%, 9%, 10% and 12% in the 4th, 5th, 6th and 7th plan consecutively. Therefore, it is clear that RBI changed its policy from cheap money to dear money policy. In the 10th plan, it has been reduced to 6%. Therefore, again RBI is following cheap money policy. Normally, as an instrument of control, BR is expected to lead to appropriate changes in all the money rates of interest, helping to achieving the objective of monetary action. Earlier, RBI fixed all the deposit and lending rates, and these rates were normally changed along with the change in bank rate, therefore enforcing direct alignment between BR and the other rates of interest. However, after 1975, other rates have often changed without changing the BR, because within the overall framework of administered interest rates, the authorities partially deregulated certain interest rates in 1985 and completely deregulated after 1991. Open market operations, OMO. OMO means sales and purchase of government securities in the open market by banks. This technique is used to expand credit by selling government securities to RBI and to control the credit by buying government securities from RBI. In the past, OMO has been used as an important means of credit control, but nowadays with the introduction of liquidity adjustment facility, OMO purchases and sales are often taken over by LAF instrument. Reserve requirements. CRR and SLR are the reserve requirement issued by RBI to control credit. Cash credit ratio as primary reserve requirements. It is the cash that banks have to maintain with RBI as a certain percentage of their demand and time liabilities. Section 42(1) of RBI Act requires every bank to maintain an average daily balance with RBI, the amount which shall not be less than 3% of total demand and time liabilities. CRR varied from 3% to 15%. CRR is usually used to tackle inflation rising out of too much liquidity in the system. CRR is an effective credit control instrument that can be used in both directions for liquidity management. Statutory liquidity ratio as secondary and supplementary reserve requirement. It is the mandatory investment in government securities. According to Indian Banking Act 1949, a bank is largely bound to keep 20% of its deposit in the form of liquid assets such as gold, approved securities and G-Secs. That was amended in 1962 and raised SLR to a minimum 25%. This ratio is used as a technique of liquidity management that is raised to control inflation and reduced to increase money supply. SLR reached its peak of 38.5% in April 1992, that is reduced to 25% in phased manner. Qualitative credit control instruments. These are selective control with specific areas meant for certain specific objectives. They do not directly affect the quantity of credit, rather qualitatively or selectively control the credit. The purpose of SCC is to change the composition of credit by reducing the supply of credit in certain areas and encouraging in desired directions. Fixation of margin requirement. RBI directs banks to change their ceilings and margin requirement from time to time depending upon the purpose, state, security and time dimensions of credit. For example, the margin requirement for wheat was fixed at 40% in 1957, it was raised to 80% in 1958 and reduced to 40% again in 1970. There are multiple differentiated margins. For example, margin requirement varied regarding various commodities from time to time. Fixation of maximum limit of loans. RBI sometimes imposes limit of loans by commercial banks in order to check speculations. No scheduled commercial bank is allowed to grant loans exceeding 1 crore to any single borrower without the prior permission of RBI. Credit rationing. Under the selective credit control, RBI fixes credit quotas for member banks and their limit for payment of bills. If member bank seeks more loans than their fixed quota, they will be charged high interest rates than normal rates. Moral suasion. This is the most effectively and consistently used technique of monetary control since the nationalization of banks. RBI can normally influence the member banks by writing letters and holding discussions about trends in economy in journal and in money and credit particularly. It advises them to expand credit in priority sector only. Here the basic purpose is to seek cooperation from commercial banks to effectively control the monetary system and the economy. Direct action. RBI can also resort to direct action against any banks in case of definance to its orders. RBI can take any measure of action like stop giving advances, closure of banks, etc. We shall now focus on liquidity adjustment facility. LAF mechanism has been introduced as one of the most innovative technique of monetary control on the recommendation of Narasimhan Committee on Banking Sector Reforms 1998. The committee recognized that RBI support the market should be through LAF, under which it would periodically, if not necessarily daily, reset its repo and reserve repo rates, which would be in a sense provide a reasonable corridor for market play. LAF provides a mechanism for injection and absorption of liquidity available to banks in order to overcome demand supply mismatches in the monetary system. LAF is a policy instrument to adjust the market liquidity on a day-to-day basis. First, the interim LAF was introduced in April 1999 with the following provisions. Bank could avail of a collateralized lending facility up to 0.25% of the fortnightly average outstanding aggregates deposits available for 2 weeks at the bank rate. Number 2, additional CLF for an equivalent amount of CLF would be available at a bank rate plus 2%. Point number 3, CLF and ACLF for periods beyond 1 week subject to a panel rate of 2% for an additional period of 2 weeks. And the last point, PDs were provided liquidity support against a collateral of government securities. The interim LAF was gradually converted into full-fledged LAF with effect from 5th June 2000. LAF works through the repo auctions and reverse repo auctions. Repo auction means sale of government securities from the RBI portfolio for absorption of liquidity. Reverse repo auction means buying of G-Secs for injection of liquidity on daily basis. The interest rate in both repos and reverse repos are decided through cutoff rates from auction on a uniform price basis. LAF helps to control both the quantum and cost of liquidity through buying and selling of repos. Here RBI periodically, if not daily, sets a repo and reverse repo rates. Repo absorbs liquidity and reverse repo infuse liquidity at a given rate. However, the quantum of adjustment and the rate are flexible in response to the needs of the market. Let us move on and study about repos. Repo means repurchase of securities. It refers to a transaction in which the party on one side sells some security to get immediate funds, and on the other side a simultaneously other agreement to repurchase the same or similar securities after a specified time at a specified rate. The repo transactions enable the parties with collateralized short-term borrowing and lending through sale or purchase of securities. It is a ready forward transaction as it is a means of funding by selling a security held on a spot basis and repurchasing the same on a forward basis. The return on repo is in the form of market determined differences between sale price and purchase price. Reverse repo. Reverse repo is exactly the opposite of a repo. It refers to a transaction in which a party buys a security from another party with a view to sell it back to the latter at a specified date and price. Therefore, a transaction in a repo for one party and a reverse repo for the other party. This type of transaction is entered into to earn the additional income on ideal funds. Importance of repos and reverse repos. Point number 1. It is a short-term money market instrument. Number 2. It is a risk-free measure because it is a full collateralized transaction because it is backed by securities. No repo transaction is feasible without the securities in the investment portfolio of the borrowers. Third point, the repo rate and related terms are negotiated by the parties and are independent of coupon rate of securities, but the rates are linked with the liquidity conditions in the market. Point number 4. Repo transactions are prevalent only amongst specified parties and only in specified instruments. Fifth point, the repos serve as a good hedging tool because the repurchase price is locked in at the time of entering into contract. Point number 6. Repo are used by RBI as an indirect instrument of money control for absorption or injection of liquidity. It is a versatile and most popular money market instrument. The last point, the repo and reverse repo rate has become akin to a signaling rate along with the bank rate. Repo rate is like a floor rate, bank rate is like a cap or ceiling for the money market, and the call rate is somewhere in between or like the middle rate. Thus, the bank rate and the repo rate have emerged as a key indicators of movements in interest rates in money market, and other money market rates like call rates respond to these rates. Market Stabilization Scheme, commonly known as MSS. There has been sharp appreciation in the value of rupee against US dollar, so RBI had to manage exchange rate of Indian economy. RBI had released rupees for buying dollar while intervening in the foreign market. The rupee so released added excess liquidity in the system. To mop up this excess liquidity, RBI used stock of G-Secs, but the stock of securities with RBI came down, causing shortage of government securities. Therefore, on the recommendation of RBI's internal working group on instrument of sterilization on Feb 23, 2004, RBI has launched MSS and formally signed a MOU with government. The scheme is effective from April 2004. Under MSS, the government would issue T-bills and dated securities for absorbing liquidity from the system. These will be issued by the way of auctions to be conducted by RBI. Government, in consultation with RBI, will fix an annual aggregate ceiling, and that ceiling will hold good till further revision. For 2005-06, the ceiling shall be rupees 80,000 crores, raised from rupees 60,000 crore as per October 26, 2004 policy. The intention of introducing MSS is essentially to differentiate the liquidity absorption of a more enduring nature by the way of sterilization from day-to-day normal liquidity management operations. Therefore, the liquidity absorption scheme from the system will get apportioned among the instruments of LAF, MSS and normal open market operations. We now recapture what we have learned so far. We have seen what money market is. Money market is a market for short-term instruments varying for a period less than or equal to 1 year. Credit control instruments. The Reserve Bank uses various quantitative and qualitative tools for managing liquidity in this system. Quantitative credit control instruments. Bank rate. It is the rate of interest charged by RBI from the banks on the loans and advances given to them. As per Section 49 of RBI Act 1934, bank rate is the standard rate at which the bank is prepared to buy or rediscount bills of exchange or other eligible papers. Open market operations, OMO. OMO means sale and purchase of government securities in the open market by banks. This technique is used to expand credit by selling G-Secs to RBI and to control the credit by buying G-Secs from RBI. Reserve requirement. CRR and SLR are the reserve requirement used by RBI to control credit. CRR, cash reserve ratio, as primary reserve requirement. It is the cash that banks have to maintain with RBI at a certain percentage of their demand and time liabilities. Statutory liquidity ratio as secondary or supplementary reserve requirement. It is the mandatory investment in government securities. According to Indian Banking Act 1949, a bank is legally bound to keep 20% of its deposit in the form of liquid assets such as gold, approved securities and G-Secs. That was amended in 1962 and raised SLR to be minimum 25%. Qualitative credit control instruments. These are selective controls with specific areas meant for certain specific objectives. They do not directly affect the quantity of credit, rather qualitatively or selectively control the credit. Fixation of margin requirement, fixation of minimum lending rates, fixation of maximum limit of loans, credit rationing, moral suasion, direct action. Liquidity adjustment facility. LAF mechanism has been introduced as one of the most innovative technique of monetary control on the recommendation of Narasimhan Committee on Banking Sector Reforms 1998. The committee recognized that RBI's support to the market should be through LAF, under which it would periodically, if not necessarily daily, reset its repo and reverse repo rates, which would in a sense provide a reasonable corridor for market play. Repos means repurchase of securities. It refers to a transaction in which the party on one side sells some securities to get immediate funds and on the other side are simultaneously other agreement to repurchase the same or similar securities after a specified time at a specified rate. The repos transaction enable the parties with collateralized short-term borrowing and lending through sale or purchase of securities. It is a ready forward transaction as it is a means of funding by selling a security held on a spot basis and repurchasing the same on a forward basis. The returns on repos is in the form of market determined differences between sale price and repurchase price. Reverse repo. Reverse repo is exactly the opposite of a repo. It refers to a transaction in which a party buys a security from another party with a view to sell it back or to the latter at a specified date and price. Therefore, a transaction is a repo for one party and reverse repo for the other party. This type of transaction is entered into to earn the additional income on ideal funds. Market Stabilization Scheme. On the recommendation of RBI Internal Working Group on Instrument of Sterilization on Feb 23, 2004, RBI has launched MSS and formally signed a MOU with government. The scheme is effective from April 2004. Under MSS, the government would issue T-bills and dated securities for absorbing liquidity from the system. These will be issued by the way of auctions to be conducted by RBI. Government, in consultation with RBI, will fix an annual aggregate ceiling, and that ceiling will hold good till further revision. For 2005-06, the ceiling shall be rupees 80,000 crore, raised from 60,000 crore as per October 26, 2004 policy. Thus, we have seen in this module that what money market is all about and what are the various facilities or instruments which are there in the money market. Rather, this module concentrate or elaborate more on the facilities. One more point to add here, the regulator of money market is RBI. One another point which I think that the reader of this particular module should come to know, RBI is one of the banks in the world which functions independently of the Ministry of Finance.